Welcome back. Futures are extending losses this morning after a tech-led sell-off yesterday. The Dow Industrials right now down 29. The S&P is down 7. And the Nasdaq down 34.5. Stocks ended down better than 1% yesterday for the second straight session. Joining me right now is Baird investment strategy analyst Ross Mayfield. Ross, it's good to see you. Thanks very much for being here. What do you think the big reaction is on Wall Street? Is it investors reacting to a slowing economy and worries that things are about to worsen in 2023 as the Fed continues to raise rates, or the impact on earnings, or what? What is most troubling to see every day another drip of a sell-off?
I think it's investors realizing that to hit kind of the perfect soft landing scenario, it's a very narrow landing strip. So you do have earnings which are probably going to come down next year. We've seen revisions down quite a bit over the last couple of months, and we have another quarter of earnings that will probably continue that trend. At the same time, you have inflation that's probably peaked, but is still far too high. You have a Fed that's getting a little bit less aggressive in its messaging, but is still raising interest rates at kind of a historic pace. So you have this, combination of things that all together make it a pretty tough 2023 on the economic side. And I think markets are just trying to find a place that makes sense heading into what's going to be a slowing year.
Yeah, but at the same time, stocks are rallying since the end of September, as expectations are that inflation has peaked. We've got the November Producer Price Index out on Friday. The expectations call for an increase of 0.2% month over month and 7.2% increase over the year. We also have the December Fed meeting next week. Now we're expecting 50 basis points when the Fed meets on December 13th and 14th. Do you think this year-end rally continues, or do you want to sell into it?
I think at this point, we're seeing a little bit of weakness over the last couple of days. I think probably it's a bear market rally. Now, I don't know if we make new lows, but I do think that a rally on the idea that inflation has peaked is maybe a little bit premature when inflation is still over 7% and the Fed is still telling us that they're going to be quite aggressive with rate hikes. I mean, a deceleration to 50 basis points is nice and all, but that's still historically fast. I mean, they were 25 basis points when they wanted to hike for the past 20 years. So this is still really aggressive policy. You still have quantitative tightening, adding to the kind of tightening of monetary policy. I think it's possible that in the early part of next year, if we don't retest the lows, we at least see some continued weakness on the idea that earnings are decelerating, on the idea that maybe valuations are a little too high now, and on the fact that the Fed still isn't done with the job.
And Ross, James Freeman here at the Wall Street Journal. The Fed is also obviously paying a lot of attention to the job market. Still looks pretty strong by most measures. Some people have said, well, the household survey doesn't show the growth that the establishment survey does. Do you make anything of this? Do you conclude that it's actually not such a great job market, or still pretty strong, which means probably still pretty strong economy?
I think it's still a pretty strong job market. I mean, if you just look at the headline numbers, whether it's job openings, unemployment rate, jobs added, and if you listen to Fed Chair Powell speak last week, there was a rally on what was perceived as dovish comments and a dovish pivot. But if you listen to his comments on the labor market, he talked about how there was still a huge imbalance in the labor market. There was still a lot of work to be done. And you saw on Friday, average hourly earnings came in above expectations. I don't think we're in, a wage price spiral that's really problematic. But if you have wage growth of 5, 6, 7% a year, that's incompatible with the 2% inflation target. So there's still work to be done.
I just wanted to add, though, you mentioned the unemployment rate, but that's what James is talking about. That household survey just in the last 2 months showed a loss of 466,000 jobs, and the payroll survey showed a gain of 547,000 jobs. That in 2 months, that is a 1 million differential, and this is according to Stephanie Pomboy. But historically, that differential, you watch the household survey for pivots when inflection points in the economy. It's the household survey that tells you where the economy is going, because that captures small businesses and independent operators, not the overall. The payroll survey is a large businesses, which have just begun to kind of cut jobs on the periphery. Say at a Facebook, it might be 11,000 jobs, but that was just, kind of excess employment that it had, people who really weren't doing anything. But it is important.